Welcome to this Robeco market update. My name is Jonathan Arthur and I'm the Client Portfolio Manager here at the Multiasset team at Robeco. If we look back at the final 3 months of 2023, if we put into words what we saw, it perhaps can be best described as a roller coaster for financial markets. But luckily for investors, there were more ups than downs. Indeed, markets continued to push forward at full steam over December, and there was the added bonus of a Santa rally. This strong finish means almost all asset classes ended strongly positive for the year as a whole, and top prize went to growth-focused equities. Now, there's been quite a lot of speculation, a lot of hope, but it feels like we've finally got there in terms of the end of the rate cycle rises. After a pretty severe sell-off in October, an unexpectedly dovish November update on interest rate policy from Jay Powell and the Federal Reserve saw equity and bond markets rebound really very sharply. They hinted that rate cuts could come as early as next spring and clarified for the first time that rising unemployment is not necessarily a condition for that rate cutting to start. The situation in the Middle East continues to be volatile, with Israel conducting strikes in both Lebanon and Syria. What's more, container ships also had to be rerouted around southern Africa to avoid the Suez Canal, and this was caused by Iran-backed Houthi rebels attacking vessels off Yemen. If this isn't resolved, it does have the potential to increase the cost of shipping goods and hike the prices that consumers pay for imported goods. And this is something that we'll be watching very closely over the coming year. Next, we turn to reviewing the performance and the positioning of the strategy over the final 3 months of 2023. And encouragingly, it did outperform the benchmark over the final 3 months of the year. Returns for both global equities and bonds were. Next, we turn to performance and positioning of the strategy over the final 3 months of the year. And encouragingly, Q4 was a period where the strategy outperformed its benchmark. Returns for both global equities and bonds for the final 3 months of the year were in the region of 5 to 7% in euro terms. And this really highlighted the high degree of correlation that we saw between major asset classes and the normalization of the volatility that we saw in the sell-off in October time. The fund added to its equity holdings over the last 2 months of the year against an improving volatility environment and following that more dovish statement from Jay Powell at the Federal Reserve at the start of November. Although this contributed to a positive equity allocation effect over the quarter, it wasn't quite enough to counterbalance the negative allocation impact from a lower fixed income exposure. This decision was taken to set a more neutral duration profile in line with our higher for longer interest rate view. Against the backdrop of lower than expected European inflation data in November, the overweight duration exposure of the Robeco Euro Government Bond Fund benefited the strategy, as European government bonds outperformed the broader fixed income market. However, on the flip side, the fund's allocation to emerging markets through equities and local currency bonds has been the main drag of relative performance, as emerging markets underperformed developed during the last quarter of the year. Now that 2023 has come to an end, focus is quickly moving to what we might expect for 2024. And one of those elements is definitely going to be the potential for rising political uncertainty. Incredibly, over half of the world's population are heading for elections in 2024. And like always, this is more than likely to bring some unexpected surprises along the way, particularly in the United States. For instance, a win for Trump could see a return of the import tariff war between the US and China that we saw a few years ago. And we all know that a trade war is bad for global trade, and with it could have negative impact on global GDP. Moving on, we think that the market is a little bit too optimistic on the number of rate cuts for 2024. In the short run, the economy might be a little bit more resilient than the market currently expects, and inflation could decelerate less quickly than everybody hopes for. We ultimately think the market has moved a little bit too far ahead, and that is creating a window for some upward pressure on rates to build. Our goal is going to be looking for opportunities to add to our bond exposure based off this view. I think given the year that we had in 2023 for equities, we have to be upfront and think there's probably a little bit less upside in 2024. There is the consensus that believes there will be this soft landing, inflation will continue to normalise, but if either one of these scenarios doesn't quite materialise, there could be some quite strong downside risk for equities. We think from here, for stock prices to move up, companies are going to have to rely on margin expansion, beating estimates, and we think that's going to be pretty difficult to do. Our intention remains to lower our equity weight. We're currently not quite willing to go against market momentum, and for now prefer to sit on the sidelines.